Hello students. Peace be upon you. How are you?
I hope you are in the pink of health.
Today we will learn about Chapter 3, the accounting cycle. Let's go.
At the end of this lesson, students will be able to 3.1 Explain briefly the steps in the accounting cycle. 3.2 Explain the types of source documents used in the business. 3.1 Steps in accounting cycle. There are 9 steps in accounting cycle. First, transactions analysis. The documents source from transaction in a business. Second, record to journals. Third, post to the ledger accounts. Next, prepare a trial balance. Then, do the adjustments with deferrals and accruals. After that, prepare an adjusted trial balance. Next step prepares financial statements, which are statement of comprehensive income and statement of financial position. Last but not least, journalize and post-closing entries. Finally, prepare a post-closing trial balance. How does a transaction take place in a business? First, a manager or other employee authorizes the transaction. Transaction may be external or internal. Then, transaction takes place. Example, Ali invested Rm10,000 as capital. But, some activities do not represent business transaction. Example, a clerk is responding to emails. Second, each transaction will change in the company financial position. Third, the businesses involved in the transaction will prepare documents that give details of the transaction. Lastly, these documents then become the basis for analyzing and recording the transaction. Transaction are a business's economic events recoded by accountant. The company must analyze to find out if it affects financial position. If it does, the company will record the transaction.
3.2 Types of source documents. The document is a source of business written as a proof for each business transaction that has occurred. There are 2 types of functions, namely business source document for reference document and the document as a source of information. Only the document's source of information should be recorded in accounting books. Okay, take a look at first documents, which is invoice. It is a document delivered by the seller to the buyer in the event of a credit transaction. It indicates the products, quantities, and agreed prices for products or services the seller had provided to the buyer. Payment terms are usually stated on the invoice. Original invoice, purchase credit, will be received by customer, and a copy of the invoice, credit sales, will be kept by seller. Next document is delivery notes. Delivered by the seller to the buyer together with the goods. Is a document that lists details about the goods delivered. Buyers can check these items. Debit note. Delivered by the seller to the buyer to inform that his account has been debited. So, customer's debt will increase. For example, the price shown is understated Rm1 per pair. Credit note. Delivered by the seller to the buyer to inform the buyer that the account has been credited. It will reduce a customer debt. It is a document to correct a mistake on an order or an invoice or to refund an amount paid. For example, customer received damaged products and wrong size. Purchase order. Sent by the buyer to the seller that contains information about the goods to be purchased. It will include a number for tracking the purchase order, the type of item, quantity and agreed upon price. Okay, students. What is receipts? It is issued by the seller when receipt of payment from the buyer. It is used as an evidence for receipts and payments have been made. Payment voucher. Internal documents provided by the business owner to record any kind of payment. The voucher is important because it's an internal accounting control mechanism that ensures that every payment is properly authorized and that the goods or services purchased are actually received. Check but. It is kept by the business and the check is given to person being paid as evidence that a payment has been made.
CHEQUE but used as a reference and resource records. What is bank slip? It is a form issued by the bank for the transaction record store or withdraw money from customers. Bank statement. Issued by the bank to the account holder at the end of the month. It is an official summary of financial transaction occurring within a given period for each bank account held by a person or business with a financial institution. Thank you students. See you in the next video. Bye.